Now we learned a little about retained earnings, which is composite. That means we do not use any exchange rate to convert retained earnings, rather is the results of the other conversions. So now if you see a little deeper here, we will see how we start business and we record retained earnings. So when we start business for the first year, our beginning retained earnings always zero. And you all are familiar with the statement of retained earnings. We add net income, we subtract dividend. This is how we get ending retained earning. So for the first year, we will see that the beginning retained earning is zero and net income is the results after converting the income statements, and dividend, if you see here from this chart, dividend always use the historical rate to convert. So we will also convert dividend, and this is how we will end up with our ending retained earnings. So first year's converted, it's not converted, but composite ending retained earning will be second year's beginning retained earning. The same thing. Net income, after doing the income statement conversions, we will find it here. And then dividend, again, we will use the historical rate. When we'll convert dividend, this is how we'll get retained earnings. So just one thing you remember, for dividend, historical rate means the date's rate when we declare dividend. So it's not the day when you pay dividend, rather when you declare dividend. So this is how retained earnings will work. Now here for cost of goods sold. So for cost of goods sold, here if you see, if you purchased all goods at the same time, then you can easily figure out the cost of goods sold. And if you remember here from our prior chart, here for cost of goods sold, current rate method use the average rates, but for the temporal method we use the historical rate. So this historical rate means what? It means that if you have the goods you purchase at different bulk on different dates, then you have to figure out the goods you bought on that specific date, and on that day's what was the exchange rate. So cost of goods sold is always recorded under the temporal method based on the historical rate. If you again purchase all of your goods or inventory on one day, you can just use that date's exchange rate. But if you purchase on different dates, then you have to calculate the cost of goods sold. So again, for cost of goods sold, historical date means the day when you purchased your inventory. It's not when you sold your inventory or paid the uh, uh, to your suppliers or collected from your customers. It's the date when you purchased and recorded the inventory for the first time. And that's what this slide is talking about. Now we will compare the two rates, and of course we'll see one example. You are familiar with this chart now. This chart will be given. Now look the current rate method. So for the balance sheet, current rates are using, method is using the latest exchange rate on the day when you are converting your balance sheet. So in one sense, you will see assets and liabilities under the current rate method, it reflects more latest numbers. On the other hand, for temporal method, it's a combination. For more liquid assets or current assets, we are using the current rates. For current liabilities, we are using the current rate even for long-term debt. But for the other assets, especially with intangibles and plant property equipment, long-term assets, deferred income, we are using the historical rates. So it's a combination. On the other hand, for stockholders' equity, it's the same, regardless of the methods. Capital stock, additional paid in capital, and dividends will always be using the historical rate. And you already have seen the structure. Retained earning is the results after doing all other parts, and it's a composite numbers. Now, if you want to look at all those conversion exchange rates, you will see here, although current rate method uh, kind of shows like more current reflections, but current rate method will result in more fluctuations because every year on December 31st or whenever you close your accounts, prepare your balance sheet, financial statement, you will have different exchange rates. So in that sense, these assets liabilities will be fluctuated after doing the conversions in terms of dollar values. So for this current rate method, you are more exposed to foreign exchange risks, although it reflects more current numbers based on the current rates. On the other hand, for temporal method, it is less exposed to fluctuations due to currency rate changes. And you will also see this historical method is also matched with our core accounting principles. One of the core principles is the cost principle. So cost principle says that long-term assets, plant, property, equipment, we always follow or record at historical cost approach. That means when you purchase it, you will always record as per the purchase price. It's called a historical cost approach, no matter what the current values of those assets. This is one of our core accounting principle under GAAP. And temporal method kind of matched with that GAP's historical cost approach. So in that sense, temporal method is better. But on the other hand, you will see current rate is very easy to apply. Average for income statement is just the average rate, only one exchange rate. Temporal use different rates. So now there are pros and cons for both methods, and it's up to the parent company depending on the functional currency which method they will be using. So two things again, you have to decide what is the appropriate method. And another is after doing the conversions, the exchange rate gain or loss will be reported where. An exchange rate gain or loss you can show on your income statement, or you can bypass the income statement and you can also show on your balance sheet under the stockholders equity part, labeling it as OCI. There are four possibilities. Now we will see what we will do here. Now, here you will see that your subsidiaries are most of the cases using their local currency, which is a foreign currency to us. But sometimes the subsidiary may also use US dollar. For example, your subsidiaries, all transactions are only with the parent company, which is located in the United States. All transactions are happening in US dollar. So subsidiary may choose to use US dollar for preparing their own financial statements. It can happen. And now, depending on what is the currency, functional currency used by the subsidiary, you have to decide the method. So if your subsidiary is using the US dollar, then you have to use the temporal method. And if your subsidiary is using their local currency means it's a foreign currency to us, right? Then we have to use the current rate method. For example, you have a subsidiary in Mexico, and that Mexican subsidiary can use Mexican peso, or they can also use US dollar. If they use their local currency, which is a foreign currency to us, if they use peso as a parent, when you will convert, you will follow the current rate method. On the other hand, if they use the US dollar, you have to follow the temporal method. And you already have seen the chart, and the columns will tell you under each method what are the exchange rates that you will be using for the conversions. FASB does not say anything which is better, what method you have to use. FASB does not have any preference. It rather depends on the parent company's choices. So here, this is kind of a summary. This table will help you to remember, and we will also remember this term functional currency. Functional currency is the currency that your subsidiaries mainly using as their primary currency, and especially to record all their financial statements. And this table, you have to remember that I'll not give you this table, I'll give you the chart that shows the conversion rates for the temporal method and the current rate method. But this table you have to remember. Now let's focus on this table a little bit. So in the prior slide, you already have learned that if the functional currency is the US dollar, you have to use the temporal method. And if the functional currency is their local currency, which is a foreign currency to us, you have to use the current rate method. Now, after doing the conversions, using different exchange rate to convert all those balance sheet and income statement numbers, you will see that you will end up with some gain or losses. What we called this conversion gain or loss. Now, where you will show the gain or losses? So, if you follow the temporal method, you will report that gain or loss on your income statement that will reflect in your net income number. On the other hand, if you follow the current rate method, the gain or loss will be reported on your balance sheet under the stockholders' equity part, and we label it or show it as other comprehensive income. So this table you have to remember. And of course, we will practice a couple of problems and we will see one big comprehensive example that will also help you. So few other terminologies and definitions, you need to know all these because for exam, you will have several conceptual multiple choice and true false questions. So it's good to know all these definitions. So reporting currency is also the functional currency. You already learned that the currency could be the US dollar or a foreign currency or their local currency. So now, if your subsidiary is using the US dollar, let's take that example we discussed. Your Mexican subsidiary is using US dollar because their majority of the transactions is happening with the US parents. Now, you can think about it. Everything is in US dollar. Why I need to convert it again into US dollar? You need to, because if you remember the chart you have seen here, this chart, some items we use historical exchange rate. Some items we use current rates. So when we are converting those to match it with the accounting historical cost principle, we still need to convert those under the temporal method. So now in summary, here what I'd like to focus on, if your subsidiary is using the US dollar, we use the temporal method. And for the temporal method, for specific items, we still need to use the historical exchange rate. So we are actually not translating the foreign currency into US dollar. Rather, we are remeasuring the US financial statement into US dollar again. And that's why the term remeasurement is used for the temporal method. So again, remember all these terminologies. US dollar is the functional currency. The parent will be using the temporal method. Although the items are in US dollar, you still need to remeasure specifically some long-term asset or long-term items. And that's why the temporal method, the process is called as remeasurement, because we are remeasuring the dollar things again into dollar, remeasurement. On the other hand, if your subsidiary is using their local currency or which is a foreign currency to us, the parents, then you have to use the current rate method. And then it's a pure translation, right? The way you